and welcome. Thank you for joining in on our topic today, balance sheet. Balance sheet is a document that shows the relationship between a company's assets, liabilities, and shareholders' equity. And at one point in time, it can be used to calculate a company's net worth. Balance sheet is one of the three financial statements that all companies are required to keep, including the cash flow statement and income statement. Anything with an economic value that a company owns counts as assets. It includes cash equipment, property rights, and more non-cash assets are thought of in terms of liquidity or how easily the assets can be converted into cash. A company's assets minus its liabilities represent the net worth of a company and its resources. A company's liabilities refers to outstanding balances that reduce the effective financial power of a company. Debt from a loan or the issuance of bonds are examples of liabilities. Shareholders' equity is the value of a company's assets minus its liabilities. This number divided by the number of shareholders represent the value of each individual shares. A balance sheet records the relationship between these three values. It is a freeze frame of a single point in time for a company, saying that at a particular moment, the company's assets are equal to X, their liabilities are equal to Y, and their shareholders' equity is equal to Z. The balancing aspect comes into play as these values fluctuate. For example, Company A has $100,000 in assets and $20,000 in liabilities, resulting in a shareholders' equity of $80,000. They take out a $10,000 loan from a bank, so their assets will increase to $110,000. Their liabilities will also increase by the same amount to $30,000. Therefore, the shareholders' equity remains at $80,000. As Company A pays back their loan, their liabilities and assets for both decrease by the same amount. And since it requires company's assets to pay back the liabilities, the shareholders' equity will remain in balance. In this chapter, we're going to talk about income statement.
Hey guys, I see you took accounting. Think you can help me with something?
What do you need?
Well, I was thinking of starting a new business, but I don't really know anything about income statement.
That's all good. We can help you. Yeah, we're sick at this. How can we help?
Well, to start off, what is an income statement?
An income statement is a financial statement showing revenue and expense accounts, and the resulting net income or net loss over a given period of time.
Okay, but what are revenue and expense again?
Revenue is an increase in equity or capital resulting from the sale of goods or services from the usual course of business. And expenses is a decrease in equity or capital resulting from the cost of producing revenue.
Oh, I see. How do I make one though?
It's really easy. All you have to do is follow 5 simple steps. Here we have Jawa's Juice Bar's income statement for the month of August 2015. The total revenue comes from the cash sales and the membership fees. And the total expense comes from the bank charge expense, heating expense, rent expense, repair expense, and wages expense. The net income is from the total revenue minus the total expense.
Are we almost done?
The final step is formatting. You need to determine the total revenue and the total expense. And to get the net income, simply subtract the total expense from the total revenue.
Do people even look at the income statement though? It seems pretty pointless.
The people who look at the income statement within your business are internal users, and the people who use it outside your business are called external users.
Oh, who are some examples?
Managers use the income statement to see how your business is doing. It helps them to make business decisions and compare trends from year to year. Also, the bank can look at your income statement. If they lend you money, they use it to monitor your ability to pay back loans. Another external user is the income tax authorities, who use it to determine how much tax you pay. You are required by law to make an income statement at least once per year.
Oh wow, that's super interesting. Do you think I can make 2 income statement one year and 3 in the next?
You have to be consistent on how many you make each year. There is a GAAP that is called the time period concept. It states that accounting will take place over specific time periods known as fiscal periods. Income statements will be created at the end of each fiscal period. Same amount of income statements each year with the same time length, so you cannot manipulate your numbers and make your company look better than it actually is.
I'm starting to understand the income statement a lot more. Thank you guys for all of your help.
Thanks for watching.